Interest rates are a crucial aspect of our economy and play a vital role in shaping our financial lives. They determine the cost of borrowing money and the returns we receive on our investments. Rising interest rates can have significant consequences on various aspects of our finances, from mortgages to credit card debt to savings accounts. But for a while now, interest rates have been at rock bottom lows. It's been super easy to borrow money, invest in the stock market, and buy a home. Unfortunately, that's starting to change. Inflation is creeping up, and the Federal Reserve is talking about rising interest rates to keep it under control. And that can have major consequences for all of us. Now, many people don't realize just how much rising interest rates can mess with their wallets. For example, if you've got a variable rate mortgage, a hike in interest rates means your monthly payments will skyrocket, and that can make it hard to keep up. But on the flip side, rising interest rates can be great for savers, who can earn way more on their savings accounts and other investments. So in this video, we're gonna dive into the nitty-gritty of how rising interest rates can mess with your money. We'll talk about how they can mess with your mortgage, your credit card debt, your savings account, and even the stock market. And we'll help you figure out how to protect your finances and keep your wallet safe. Trust me, you want to be informed and prepared for whatever interest rates throw your way. Whether you're a homeowner, a saver, or an investor, understanding how rising interest rates can mess with your finances is crucial. So, let's get started on this crazy ride to uncover the shocking truth about rising interest rates in your wallet. It's going to be wild. Chapter 1. What are interest rates? Interest rates are the cost of borrowing money, typically expressed as a percentage of the total loan amount. Lenders charge interest rates as a way to earn a profit on the money they lend, and borrowers pay interest rates as a cost for borrowing the money. Who sets interest rates, you ask? Well, it can be anyone from banks and credit unions to the bigwigs at the Federal Reserve. Banks and credit unions usually determine their interest rates based on market forces, while the Fed uses its monetary policy to influence interest rates for the entire economy. There are three primary types of interest rates: nominal, effective, and real. First up, we have the nominal interest rate. This is the rate that's stated on your loan or investment, and it's used to calculate the interest payments. For example, if you invest €10,000 at a nominal interest rate of 5% for 1 year, you'll get a return of €500. Not too shabby, right? Next, we have the effective interest rate, or AER. This takes into account compounding over the entire investment term, and it's used to compare different interest rates with different compounding periods, like daily, monthly, and annually. So if you have a nominal interest rate of 5% compounded quarterly, your effective interest rate would be 5.095%. If it's compounded monthly, then your effective interest rate would be 5.116%. And if you're really ballin' and it's compounded daily, then your effective interest rate would be 5.127%. Finally, we have the real interest rate, which is super helpful when you're trying to figure out how inflation is affecting your investments. This subtracts the inflation rate from the nominal interest rate, giving you the actual return on your investment after adjusting for inflation. So if the nominal interest rate is 5% and inflation is also 5%, then your real interest rate is 0%. In other words, you're not really making any money, you're just keeping up with inflation. So, why do interest rates fluctuate? A few factors can influence them, including inflation, economic growth, and demand for credit. When inflation is high, lenders usually want higher interest rates to make up for the decrease in purchasing power of their loaned money. And when the economy is doing well, and there's more demand for credit, interest rates can go up too. Chapter 2. The impact of rising interest rates on consumer spending. Rising interest rates can have a significant impact on consumer spending. When interest rates increase, the cost of borrowing money increases, making it more expensive for consumers to take out loans and make purchases. This can lead to decreased spending on big-ticket items such as homes and cars. Mortgages, in particular, are feeling the pinch. Who knew that just a little uptick in interest rates could make it so hard for some people to afford their homes? This could mean a slowdown in the housing market and a bunch of folks forced to start camping in their backyards. And don't even get me started on the auto industry. When car loan interest rates go up, buying a car suddenly feels like a luxury item only reserved for royalty. This can lead to decreased demand for cars and a slowdown in the auto industry. Even credit card debt isn't safe from the wrath of rising interest rates. Who knew that our little plastic friends could be so finicky? Credit cards typically have variable interest rates that are tied to the prime rate. When the prime rate increases, credit card interest rates can also increase, making it more expensive for consumers to carry balances on their credit cards. This can lead to decreased spending on other items, as consumers try to pay off their credit card debt. But wait, it gets worse. All this belt-tightening and penny-pinching could have ripple effects throughout the economy. Businesses might start to feel the burn from decreased sales, leading to layoffs and a general slowdown in the overall economy. I don't know about you, but I'm feeling a little queasy just thinking about it. So, what can we do to protect ourselves from the interest rate bullies? Well, we could start paying down our debt before interest rates rise, or we could consider fixed rate loans to protect ourselves from future interest rate hikes. Or we could all just start stuffing our mattresses with cash and hope for the best. Chapter 3. The impact of rising interest rates on borrowing. Interest rates are a key component of borrowing, and changes in interest rates can have a significant impact on borrowing. When interest rates rise, borrowing becomes more expensive, and suddenly everyone is tightening their belts and searching for coins in their couch cushions. It's like the universe is conspiring against our shopping sprees. And the impact of rising interest rates on borrowing, well, it's not pretty. When borrowing becomes more expensive, people and businesses are less likely to take out loans. So, if the interest rate on a mortgage goes up, home buyers may run for the hills, or, more likely, the rental market. Good luck selling your overpriced property now, pal. But wait, there's more. Rising interest rates can also lead to increased costs for borrowers. If you have an adjustable rate loan, your monthly payments will shoot up like a rocket as interest rates rise. Suddenly, your budget is as tight as your skinny jeans after a big meal. And if you can't keep up with your loan repayments, you might end up with a credit score lower than a limbo pole. And let's not forget about businesses. They rely on borrowing to finance their operations, and when interest rates rise, their borrowing costs increase too. Suddenly they're shelling out more cash than a high roller at a Vegas casino. If they can't raise their prices to cover these costs, they might have to close up shop and start selling knickknacks on Etsy instead. So, my advice to all you borrowers out there, keep an eye on those interest rates. And if things start getting too crazy, it might be time to start looking for alternative financing options. Maybe start a Kickstarter campaign, or convince your rich uncle to invest in your fledgling startup, whatever it takes to keep the cash flowing. Chapter 4. The impact of rising interest rates on investment. Interest rates play a vital role in determining the overall health of an economy. When interest rates rise, it can have a significant impact on investment. Investors must carefully analyze the market conditions to make informed investment decisions. In this chapter, we will explore how rising interest rates can impact various investment opportunities and the economy as a whole. Let's start with stocks, one of the most popular investment options out there. When interest rates go up, companies have to pay more to borrow money, and that means they may not have as much dough to fund their operations. And as we all know, no money means no profit, which means investors start to run for the hills. It's like a scene from a horror movie. Except the killer is rising interest rates, and the victims are our beloved stocks. Bonds are another popular investment option, but when interest rates go up, their value takes a dive. And if you're a bondholder, that's not good news. With new bonds being issued at higher interest rates, who would want to keep their old, less attractive bonds around? It's like trying to sell an old smartphone for top dollar after a new one has been released. Not gonna happen. Real estate. Rising interest rates can make it tough for people to get a mortgage, which can lead to a decrease in demand for homes. And that, my friends, can send the prices of homes plummeting. But there is a silver lining. With more people unable to afford a mortgage, rental properties may see a surge in demand. All in all, rising interest rates can take a toll on the economy as a whole. They can lead to decreased investment, decreased consumer spending, and even impact the job market. It's like a never-ending domino effect of financial woes. So if you're an investor, it's important to keep an eye on those interest rates and analyze the market conditions before making any decisions. Otherwise, you might end up like that person who always gets eliminated first in musical chairs. Nobody wants that. Chapter 5. How to protect yourself from rising interest rates. As we've discussed in previous chapters, rising interest rates can have a significant impact on consumer spending, borrowing, and investment. To protect themselves from these impacts, individuals and businesses can use various strategies to mitigate their risks. One of the most effective ways to protect yourself from rising interest rates is to reduce your debt. When interest rates go up, the cost of servicing your debts increases, making it harder to make payments on time. By reducing your debt, you can lower the amount of interest you owe and free up more of your income to save and invest. Another strategy to consider is diversifying your investments. While rising interest rates can negatively impact some investments, other types of assets can actually perform well during these periods. For example, bonds tend to do well during times of rising interest rates, as their yields increase in response to higher rates. Real estate investments can also be a good option, as they tend to be less sensitive to interest rate changes than other types of investments. In addition to reducing debt and diversifying investments, it's important to prepare for potential economic downturns. During times of economic uncertainty, interest rates can fluctuate rapidly, making it more difficult to manage your finances. To prepare for these scenarios, consider building up an emergency fund with enough money to cover at least 3 to 6 months of living expenses. This can help you weather financial storms without having to resort to high-interest loans or credit cards. Finally, it's important to stay informed and aware of economic conditions that can impact interest rates. Keep up to date on news and trends in the financial world, and seek the advice of financial professionals when necessary. By staying informed and making smart financial decisions, you can protect yourself from the impact of rising interest rates and ensure that your financial future remains secure. Rising interest rates can have a significant impact on the economy and individuals' finances. However, with careful planning and preparation, it is possible to minimize the impact of rising interest rates on your wallet. By understanding the factors that influence interest rates and taking steps to protect yourself, you can navigate the ups and downs of the economy with confidence. Don't forget to hit that like button and subscribe to our channel for more tips on financial planning and economic trends. Thanks for watching.